It's been a few years since we've seen much fear in the market, but that's starting to change a little bit. The last few weeks, we've seen a big slide in tech stocks and even concerns about a potential recession for real this time in the midst of trade wars and signs of slowing economic growth. If you feel like your portfolio has been a little bit more of a roller coaster ride than you would desire and are looking for a little defense, I made this video for you because I'm going to walk through 10 of my favorite recession-proof dividend stocks. Each stock yields at least 3%, some as high as 6% plus. They've all paid safe dividends for at least 20 years, with some paying a safe dividend for more than a century. And each company also outperformed the S&P 500 during the 2008 financial crisis, with some even showing a gain during that period of time. A lot of dividend stocks have been out of favor for a couple of years now, so many of these stocks also look pretty undervalued relative to the market. So stay tuned. Let's look at these 10 names. If you're looking for defense, safe havens, these could be ideas for you to consider for your portfolio. First up is Public Storage, ticker symbol PSA. You've likely seen their buildings around. Public Storage is one of the largest self-storage REITs in the world. It has over 3,000 properties spanning 40 states, as well as a footprint in Europe. The company's been in business since 1972 and owns over 3,000 properties in total that serve around 2 million customers. Now, self-storage is a great industry for recessions because even though consumers are spending less, they still need to store their stuff somewhere, and it's a pretty big pain to switch where you're keeping your stuff. It's not really worth moving everything just to save $10 a month or something at a rival storage facility. You can see that this has caused or enabled rent to steadily increase over the years for Public Storage and most of its peers because there are those switching costs involved. During the financial crisis in 2008, the industry's cash flow per share also fell by less than 5%, according to Bank of America, kind of highlighting its stickiness. Now I'm going to hop over to our website and pull up Public Storage's stock page here to give you a quick look at some of the fundamentals behind the company. So PSA has a dividend yield of about 4%. We give it a very safe dividend safety score of 96, and S&P assigns a credit rating of A. Now, the dividend has been paid safely every year since 1981. That's over 40 years of uninterrupted payouts. Dividend growth has been a little less predictable in recent years. It was frozen for about 7 years, and then management hiked the dividend by 50% in 2023. Now, the dividend is really well supported by cash flow. You can see PSA's payout ratio sits near 80%, which is in line with its long-term norm. The company has a great balance sheet, as we mentioned earlier, with its credit rating. And the stock right now, if it were to trade near its 5-year average valuation multiple, looking at price to AFFO, it's right at the low end of the range you would expect. The price is $311, the expected price $295 to $361. So the valuation looks quite reasonable for what's been a defensive company through past downturns. During the financial crisis, PSA's stock lost 38%, while the S&P 500 fell 55%. So self-storage is a good place to be, relatively speaking, during recessions, and Public Storage is one of the best companies in that industry. You don't usually think of the energy sector as a recession-resistant part of the market, but we're heading there next with a look at Enterprise Products Partners, ticker symbol EPD. This is a master limited partnership that has paid uninterrupted distributions since going public in 1998. The company is one of the largest midstream service providers in the country today, with over 50,000 miles of pipeline, a bunch of storage facilities, natural gas processing trains. Enterprise essentially helps producers of oil and gas bring their product from the wellhead all the way down to end consumers, generating fees at almost every step along the way. Now, energy prices go all over the place, but EPD is different because they generate most of their cash flow from fixed fees under long-term contracts that have minimum volume commitments, as well as annual rate escalators to help offset inflation. So this dynamic allows the company to generate very stable cash flow even when the price of oil and gas is falling. If we head on over to Simply Safe Dividends, we'll take a look at this business again. 6.5% dividend yield today at Enterprise Products Partners. We give a safe dividend safety score of 65, and S&P assigns a credit rating of A-. So again, a very conservative operator with a strong balance sheet here. The distribution has been growing for every year for more than 25 straight years, kind of recording mid-single digit dividend growth of about 4 to 5% per year on average. That seems like a pretty good bet to continue. If you come down here, you'll see that Enterprise Products has a payout ratio that sits a little under 60%. So very conservative here with a good margin of safety and headroom to keep that distribution growing. From a valuation perspective, the midstream space has done really well the last year or two. Enterprise Products is no exception. The stock looked really cheap during the depths of the pandemic. You can see its expected price never fluctuated, which in this case is based on the 5-year average dividend yield, kind of getting back there as a buoy for value. Right now, the stock trades a little bit above that range, so it's not a tremendous bargain, but it's a stock that has done surprisingly well in past recessions. A lot of the midstream space and energy gets crushed, but because Enterprise has such a strong cash flow stream with its contract structures and asset footprint, as well as a safe balance sheet and no need to issue equity, this stock was only down 37% when the S&P 500 lost 55% during the financial crisis. Our third recession-proof dividend stock is General Mills, ticker symbol GIS. This business has been around since 1866, but didn't entirely focus on consumer foods until 1995. General Mills sells a lot of the staple goods that consumers keep buying even in economic downturns, like cereals, baking products, and snacks. You can see that the company has a handful of billion-dollar brands like Cheerios, Nature Valley snack bars, Blue Buffalo pet food that contribute to its roughly $20 billion in annual revenue. The portfolio itself is pretty diversified. You'll see here in this pie chart that no category really exceeds 25% of total sales. You have a nice mix of snacks, cereal, meals, pet food, and dough, which again kind of hedges from any adverse developments in any one of those categories. If we hop over to our website, we'll take a closer look at the stock here. General Mills yields 3.9% today. The packaged food space has really not done well the last couple of years. You can see General Mills price has come down from around $90 a share to $60 today, almost $60, which is a little bit below the expected price range based on the stock's 5-year average PE ratio. And that really reflects coming off of the pandemic. Price hikes were big and consumers were paying those prices, but now we've seen a more competitive environment. Consumers are seeking more value. Growth has slowed or even turned slightly negative. But I think this is a business that will still do well in a recession. If you turn back the clock, during the financial crisis, General Mills sales were actually up 0.1% during that time. The stock only lost 12%, while the S&P 500 fell 55%. So it was a super durable business. The dividend was safe, of course. It's been paid without interruption for an astounding 126 straight years. Growth over the long run, I'd kind of expect low to mid single digit dividend growth, maybe 3, 4, 5% a year. The dividend certainly looks like it continues to deserve a very safe dividend safety score. The company's payout ratio sits below 60%, which is near its lowest level in the last decade. The balance sheet is good, like we saw earlier, with a BBB credit rating from S&P. So General Mills, it could be a more promotional environment, harder to kind of earn business from consumers in the event of a recession. But I think this is a company that'll still outperform the market if that does take place. And it gives you a nice 4% dividend yield today, which is near the highest it's been really since the depths of the pandemic. So the valuation looks relatively attractive with low expectations for what is a very nice cash cow business with entrenched brands. Next, we will head to the real estate sector to take a closer look at Realty Income, ticker symbol O. Realty Income is one of the largest global REITs and pays a monthly dividend, which makes it popular with income investors. The company owns over 15,000 commercial real estate properties, mostly focused on retail. These properties are leased to over 1,500 clients operating in nearly 90 industries. So Realty Income's sources of cash flow are very diversified. No tenant exceeds 3.5% of rent, and its biggest industry exposures are convenience stores and grocery chains, which add up to about 20% of overall rent and are known to be pretty recession-resilient businesses. Realty Income also focuses on tenants that have more of an essential mix of products or low price points, or are more kind of experiential, service-oriented businesses that are resistant to e-commerce. Those can hold up better in downturns. And its leases have very long terms. There's a weighted average lease term remaining on its portfolio of over 9 years. That has helped keep occupancy above 96% throughout Realty Income's history, including the financial crisis. Hopping over to our website, Realty Income has a 5.6% dividend yield right now. It earns a safe dividend safety score and an A- credit rating from S&P. Now, the increase in interest rates the last couple of years has weighed on the REIT space, and Realty Income is no exception. The stock is kind of down where it was from almost 5 years ago and is starting to look pretty reasonably priced. The yield you can see is not quite where it reached during the depths of COVID, but it's up there at 5.6%. The company is still squeaking out some growth despite a more challenging environment because of high interest rates, raising debt costs, and slowing the pace of acquisitive growth. Realty Income's payout ratio sits at 75%, which is its lowest level in a decade. So there's a lot of good support for the dividend there, which is again paid out monthly and has continued growing at kind of a low single-digit pace. 2-3% a year is probably what you can expect. But the dividend has been very reliable ever since the company's founding in 1969. The dividend has been paid safely. So Realty Income is a blue chip REIT. It's going to be a little sensitive to wherever bond yields go because this is such a bond-like stock with slow growth and a high dividend. But it's a decent holding in the REIT space, at least during recessions. Its sales hardly budged during the financial crisis. Its stock did fall 43%, but that was still a lot better than the S&P 500, and you were collecting those safe monthly dividends, which can provide nice peace of mind throughout that time. Chevron, ticker symbol CVX, is our next recession-proof dividend stock that has roots tracing all the way back to 1879 when it discovered an oil field near Los Angeles. Today, Chevron is one of the biggest oil majors in the market. The company has upstream, midstream, and downstream operations. It generates most of its profits from exploring for and producing oil and natural gas, but it also uses some of those resources and turns them into fuels like gasoline, as well as lubricants and various chemicals and additives. So having this integration helps Chevron weather these different cycles in the energy space because when the price of oil is down, for example, that can serve as a cheaper input to make fuel. So that kind of helps protect the company's cash flow over various cycles. Taking a closer look at the business, Chevron has a 4.5% dividend yield, earns a very safe dividend safety score, and has a AA- credit rating from S&P, which reflects its very conservative nature. That's helped Chevron pay a safe dividend for over 110 years and raise its dividend every year for over 35 straight years, kind of recording mid to upper single-digit dividend growth over the last couple of decades. Now, Chevron is a holding in Warren Buffett's portfolio. He bought in late 2020, so kind of during the depths of the pandemic when oil prices were crushed. Chevron looked very cheap compared to our expected price here based on its 5-year average dividend yield at the time. So Buffett got a great price, and of course Chevron has since recovered nicely and looks reasonably valued today. But how can a business this volatile pay safe dividends for so long? I mean, you can see here that earnings flipped negative in 2020. The payout ratio has been all over the place. Well, the secret to this is kind of twofold. One is Chevron always maintains a very safe balance sheet. So by keeping its debt levels so low, Chevron can borrow money for a period of time when oil prices are depressed to help support its dividend. The company's scale and diverse resource base and integrated model as well also helps keep its costs down and allows it to have a break-even price of about $50 per barrel of oil. That's the price at which Chevron has estimated it can cover its dividend and capital spending without having to borrow any money. Now, during a recession, the price of oil will fall below that, but Chevron can lean on its balance sheet like it has over many different cycles to keep dividend investors safe until better times arrive. This has all helped Chevron outperform the S&P 500 by over 20% during the financial crisis and could set the company up well to outperform in the next recession as well, even if the price of oil falls. Next up is WEC Energy, ticker symbol WEC. This is a regulated utility company, and utilities are known for being pretty good recession-proof stocks because they provide essential services that are allowed to earn a reasonable return on capital by regulators. So they generate very stable cash flow whether times are good or bad. WEC Energy has roots tracing all the way back to 1896 and is kind of balanced between providing electricity and gas, focusing mostly on Wisconsin, and then it also does some business in Illinois, Minnesota, and Michigan. Now, WEC Energy, if we hop over to our website here, currently offers a yield of almost 3.5%. We give it a very safe dividend safety score, and it earns an A- credit rating from S&P. The stock has been a very reliable dividend payer for more than 2 decades. The dividend has pretty consistently grown around 7% per year in recent history and is likely to continue doing that. Compared to some of its peers, WEC Energy hasn't benefited quite as much from the excitement around AI. You can see the stock is largely unchanged the last couple of years with its price. It started to recover because it looks like it had gotten so cheap compared to where it usually trades, but it still appears just slightly reasonably valued, kind of that bottom end of the expected price range. So the valuation looks interesting for a company that's been so reliable and consistent growing its dividend. It doesn't, like I said, have any of the AI hype with data centers. That's not a huge driver of demand in Wisconsin or Illinois. But WEC Energy has been a great stock for long-term dividend growth investors and remains a model of consistency. Its payout ratio is very stable at just under 70%. That should allow the dividend to keep growing with earnings, which have marched up like clockwork, including throughout the pandemic. They're expected to grow about 7% in the year ahead. So you're probably looking at another 6-7% dividend raise over that time period as well. So WEC Energy operates in areas, like I said, Wisconsin is around 70% of its asset base. It's known for being a territory or a state that's been quite favorable with how they've treated utilities. They've been very fair over the years. So WEC Energy, not the most exciting business, but one that's been very reliable and gives you that 3.5% yield, which should keep growing at around 7% annually going forward. The next recession-proof dividend stock is Kimberly Clark, ticker symbol KMB. This is a dividend aristocrat and dividend king that has grown from humble roots as a simple paper mill founded back in 1872 to a global leader in tissue and hygiene products. I recognize a lot of these familiar brands here, including $5 billion brands like Huggies, Kleenex, and Scott. Kimberly Clark sells a lot of essential products that people keep using when times get tough, like diapers and paper towels. About 1/4 of the world population uses one of Kimberly Clark's products every day, which is an amazing testament to the company's reach and the essential nature of what it sells. Looking at the company's stock page on Simply Safe Dividends, shares yield 3.5% today. They earn a very safe dividend safety score and an A credit rating from S&P. The dividend has been paid reliably for 90 straight years, including over 50 consecutive years of dividend growth. The growth profile is not amazing. It's been about 3% per year the last few years, really, and closer to 6% per year on average the last 2 decades. Now, the dividend does look quite safe, in part because Kimberly Clark's payout ratio is stable, kind of in the 60% type level where it's been throughout the last decade for the company. Demand really doesn't fall much for these products when the tide goes out. Kimberly Clark's sales were down 4% during the financial crisis. A lot of consumers will trade down. They're looking for more value when times get tough, but Kimberly Clark plays across all the pricing tiers and has a dominant market share position in things like diapers. So the company doesn't usually see a huge hit when that dynamic changes. The stock also outperformed the S&P 500 by about 20% during the financial crisis. Shares look pretty reasonably valued today. They haven't really gone anywhere for the last decade. They're sitting kind of square in the middle of that expected price range today. But Kimberly Clark is kind of a nice bond-like stock that gives you a reasonable starting yield with some kind of low to moderate growth, but better than nothing over the long run, while doing its best when the tide goes out. Johnson & Johnson, ticker symbol JNJ, is a company that has historically done quite well in past recessions. If you're unfamiliar with the business, it's a healthcare giant that generates about 60% of its revenue from a very diverse portfolio of patented medicines spanning lots of different treatment areas, from cancer, oncology, to neuroscience, infectious diseases, immunology. J&J is not overly dependent on any single drug. The rest of the portfolio comes from medical devices and technologies. That's about 40% of sales. Everything from joint replacement solutions and orthopedics to heart rhythm management devices and cardiovascular, contact lenses, surgery solutions. So again, a very diversified portfolio of products that generally have leading market share positions. J&J is kind of the epitome of a safe stock. It has a higher credit rating, AAA, than the U.S. government. It earns our highest dividend safety score of 99. The company has paid a safe dividend for over 100 straight years, grown that dividend over 60 years, kind of at a mid-single digit pace in recent times. J&J's portfolio does quite well in recessions typically. Sales fell by 6% during the financial crisis. the stock outperformed the S&P 500 by about 30%. If you're dealing with conditions like arthritis, diabetes, joint pain, certainly cancer treatments, you're going to continue those things when times are tough. And that typically results in stable demand for these healthcare companies. J&J's valuation today looks pretty reasonable. The stock hasn't really gone anywhere in the last 5 years. Investors have not really been focused much on defense lately until this year. The stock has kind of rallied a bit and sits at the very low end of its expected price band based on the 5-year average dividend yield, which has tracked the stock pretty well historically speaking. J&J's dividend remains on solid ground. The payout ratio sits near 50%. The company is so big, it's on pace to retain about $10 billion of free cash flow after paying dividends. So I know some investors have kind of worried about the talc lawsuits that Johnson & Johnson has faced with its baby powder business, but this is just a cash cow, a cash machine. So the size of those liabilities that'll be paid out over a long period of time once everything is settled really isn't a big concern at all to J&J's dividend profile or ability to keep making acquisitions and protecting its patented medicine side of the company. So I think J&J is a really good stock to own when times are tough, and it's a pretty reasonable defensive holding even during good times as well, with kind of moderate dividend growth and today getting a 3% starting yield. Flowers Foods, ticker symbol FLO, sells a product that is one of the first off the shelves during times of emergencies or big storms. We're talking about bread. Flowers owns the #1 loaf bread brand, Nature's Own, as well as the leading organic and gluten-free brands Dave's Killer Bread and Canyon Bakehouse. The company operates 45 bakeries across the U.S. It's one of the biggest bread companies in America. You can see its market share is just under 20%. Mostly makes money from branded retail products, which also carry higher margins, and they're sold throughout big supermarket and mass discount stores like Walmart. Looking at the company's fundamentals here, Flowers offers an unusually high yield of about 5.2% today. The company earns kind of a low, safe dividend safety score from us and has a BBB credit rating from S&P, although there's a negative outlook on that, reflecting a recent acquisition. Flowers has gotten pretty beat up the last couple of years. Defensive stocks have been out of favor, but bread has also been kind of a challenged growth category. Volumes have been declining a bit, and there's some worries about whether this is a cyclical pressure with consumers being more promotional or more of a secular headwind the company might need to address by expanding more into snacks. Assuming we do see kind of a snapback, the company does look pretty undervalued today compared to where you'd expect it to trade based on its 5-year average dividend yield. The dividend itself, the payout ratio Flowers maintains, has typically been kind of in the 70% type of range. Again, this is a business that just generates tons of free cash flow, very predictable sales. During the financial crisis, Flowers did very well. Sales dipped less than 3%, and the stock was basically flat while the S&P 500 lost over half of its value. Investors would be thrilled if we had that type of outcome again in a downturn. For now, I think Flowers kind of has some growth questions to address to get the stock improving longer term. But again, this is a business that remains a cash cow that's moving more into snacks, which have a little bit more growth potential than bread. And I hope it's able to bounce back. Either way, it's a nice 5% yield that looks safe for now and probably continues to see kind of that 2 to 4% type of dividend growth until top line trends improve. The final recession-proof dividend stock is Consolidated Edison, or Con Ed, ticker symbol ED. This business was founded in 1823 and provides energy for the 10 million people who live in and around New York City. Almost all of the firm's earnings are generated from regulated activities, including the transmission and distribution of electric and gas power. Taking a look at the company here, we can see Con Ed offers a 3.4% dividend yield today, earns a very safe dividend safety score and an A- credit rating from S&P. Utilities, like we've mentioned earlier in this video, are known for being good recession plays. They're very defensive. They provide essential services. They're getting paid to deliver electricity and gas. Their rates are controlled by regulators to ensure they earn a fair return. So Con Ed during the financial crisis was down 26%, much better than the S&P 500, off 55%. Now, the other thing that's notable about this stock is that it has the longest dividend growth streak of any S&P 500 utility company, with last year being its 50th straight dividend increase. That's a remarkable record, even though dividend growth has been pretty underwhelming at about 2% per year on average. I could see that picking up, though, in future years. If we come down here, we can see that the company's earnings have grown faster than its dividend, which has reduced its payout ratio to 60%, its lowest level in a decade. Most utilities are kind of comfortable in that 65-70% range. So we could see earnings, or the dividend rather, grow more in line with earnings going forward, which would be welcome news for dividend growth investors. Looking at valuation, the stock has very closely tracked its 5-year average dividend yield over time. And right now it kind of sits near the high end of that expected price band. So shares look reasonably valued, and I think they would do quite well in the event of a recession. I wish the yield and growth combination would be a little bit higher than it is, but Con Ed is a stock that I own and I think is a good one when times get tough. I hope you're able to get a few interesting income ideas for your portfolio in case we do hit a rougher patch coming up here. But I do want to be clear that I think Peter Lynch had it right when he said something like, more money has probably been lost by investors trying to anticipate or avoid corrections than in the corrections themselves. There's definitely something to be said for time in the market matters more than timing the market. And the same is true with making big changes to your portfolio, kind of anticipating what might happen next. Nobody has a crystal ball. I certainly don't. So for me, I like finding a strategy that makes sense, that's simple to execute and stay with through good and bad times. That's dividend growth investing for me and a lot of our members of Simply Safe Dividends. Doesn't have to be true for everybody else, but I want you to keep that in mind as you anticipate the volatility in the market right now and some of these recession-proof stock ideas that I shared. If you enjoyed this video, it would really help me out and support the channel if you considered liking the video and even subscribing to our channel. I try and publish usually around 3 or 4 videos a month that are focused on dividend stock analysis and ideas to share like the one in this video. I also focus on income investing topics. None of the nonsense that's out there on YouTube, just objective, straightforward financial tips and lessons that I've learned over my investing career. Thank you for watching, and I hope to catch you next time.